The market doesn't care about your feelings, it doesn't care about your theories, and it certainly doesn't care about what you think should happen next. The market is a cold, calculating mechanism that rewards discipline and punishes weakness, especially the weakness of fear. Not the fear of loss, which is healthy, but the fear of missing out, which is deadly. FOMO, fear of missing out, is the silent killer that turns rational investors into desperate gamblers. It's the voice that whispers everyone else is making money but you when you see a stock skyrocket. It's the impulse that makes you chase a momentum trade long after the smart money has already positioned itself. It's the psychological trap that convinced you to buy crypto at its peak, tech stocks in 1999 or real estate in 2007. Here's the brutal truth about FOMO. By the time you feel it, you're already too late. The opportunity has already been identified, exploited, and often exhausted by those who moved first. While you're frantically buying, they're quietly selling. While you're celebrating your entry, they're counting their profits on the exit. But what if there were a systematic way to test the water before diving in? What if you could participate in momentum without surrendering to emotion? What if you could transform FOMO from your greatest weakness into a signal that triggers your most disciplined response? Jesse Livermore, perhaps the greatest trader who ever lived, developed exactly such a system. He called it the test trade rule, a psychological circuit breaker that allowed him to participate in market moves without becoming a victim of his own excitement. This wasn't just a trading technique, it was a profound psychological framework for maintaining control when everyone around him was losing theirs. The test trade rule doesn't eliminate FOMO, it weaponizes it. It transforms that desperate urge to chase into a structured process that protects capital while still allowing for participation. In today's market of instant information and commission-free trades, Livermore's century-old wisdom has never been more relevant. In the fall of 1906, Jesse Livermore stood at his ticker tape, watching Union Pacific Railroad shares climb steadily higher day after day. The market was strong, the trend was clear, and everything in his analysis told him to buy. But something held him back, a discipline born from painful experience. Instead of plunging in with his full capital as emotion urged him to do, Livermore entered what he called a test trade, a small position designed not to maximize profit, but to test his thesis with minimal risk. Union Pacific continued its ascent, and only after his test confirmed the momentum did Livermore begin pyramiding his position. By the time the great San Francisco earthquake hit financial markets, he had built a substantial stake at favorable prices without the emotional baggage of FOMO. When panic struck and others were selling at any price, Livermore's methodical entry allowed him to maintain his conviction and ride out the volatility. This wasn't luck, it was system. Just 7 years earlier, Livermore had nearly been destroyed by the very impulse his test trade rule was designed to control. During the Northern Pacific corner of 1901, he had watched from the sidelines as the stock soared from $110 to $180, battling the urge to jump in. When it crossed $200, his discipline finally broke. FOMO overwhelmed analysis. He bought aggressively near the top, only to be crushed when the stock collapsed as quickly as it had risen. The pattern repeated throughout his early career, discipline abandoned in moments of market excitement, followed by devastating losses. The desire for constant action, irrespective of underlying conditions, is responsible for many losses. Livermore later wrote, "Remember that stocks are never too high to begin buying or too low to begin selling." The critical insight Livermore gleaned from these painful lessons wasn't about market timing, it was about psychological control. Markets don't just move in cycles of price, they move in cycles of emotion. Greed, fear, complacency, and panic take turns driving behavior. The test trade rule wasn't merely about entering positions, it was about entering the right mindset. Consider how this applies today. When Bitcoin surged past $60,000, social media exploded with stories of overnight millionaires. Investment groups buzzed with speculation about $100,000 target. The narrative of easy money and unlimited upside created irresistible psychological pressure. Those who succumbed to FOMO and bought near the top weren't making investment decisions. They were responding to social contagion. They weren't buying Bitcoin, they were buying the story of Bitcoin. The price they paid wasn't just financial, it was psychological, the cost of surrendering control. Livermore understood that the most dangerous market condition isn't a bear market or even a crash. It's a market that makes fools look like geniuses. When everyone seems to be making easy money, the temptation to abandon discipline becomes overwhelming. The test trade rule created a structured release valve for this pressure. a way to participate without capitulating to impulse. It acknowledged the reality of human psychology while imposing the guardrails of system. The genius of Livermore's approach wasn't that he eliminated emotion from trading, it was that he created a framework where emotion could exist without becoming destructive. His system didn't fight human nature, it channeled it. The market presents us with a fundamental paradox. It rewards decisive action, yet punishes impulsive decisions. It demands commitment, yet destroys those who commit too deeply too quickly. It requires both courage and caution, often simultaneously. This tension creates the perfect breeding ground for FOMO, perhaps the most expensive emotion in trading. FOMO attacks your decision-making at its foundation. It replaces analysis with anxiety, strategy with urgency, and discipline with desperation. When you act from FOMO, you're no longer trading your plan, you're trading your emotional state. Your entry isn't based on value or even timing, it's based on the unbearable tension of watching others profit while you wait. What makes FOMO so dangerous is that it masquerades as opportunity. It doesn't feel like a mistake when you're making it. It feels like finally seeing the light, like catching the last train, like seizing the moment before it vanishes forever. This is precisely why conventional wisdom fails to protect against it. Telling yourself to be disciplined or control your emotions does nothing when those emotions have already hijacked your decision-making system. Livermore understood this at a profound level. He recognized that the solution wasn't to suppress the impulse to act, it was to channel that impulse through a framework that contained its destructive potential. This was the essence of the test trade rule. The rule is deceptively simple. When you feel the urge to enter a position, particularly one driven by market momentum or excitement, start with a fraction of your intended position size, perhaps 10–20%. This initial position isn't primarily about profit, it's about psychology. It's a diagnostic tool that allows you to experience market movement without risking your full capital. But how does such a simple adjustment transform your psychology so dramatically? First, the test trade converts an all-or-nothing decision into, instead of agonizing over whether to enter with your full position, you're deciding how to build your position over time. This immediately reduces the psychological pressure that fuels impulsive action. Second, it changes your relationship with market movement. With a test position, a move against you isn't a disaster to be denied, it's valuable information to be processed. A move in your favor isn't vindication to be celebrated, it's a preliminary confirmation to be tested further. The small size creates emotional distance that allows for clearer analysis. Third, it creates multiple decision points instead of a single moment of commitment. Each increment in position size becomes a deliberate choice based on evolving information rather than a reaction to FOMO. You're no longer jumping aboard a moving train, you're methodically building your exposure as evidence confirms your thesis. Consider how this would transform your experience during a typical market surge. Without the test trade rule, you face an excruciating binary choice: commit substantial capital at current prices or watch from the sidelines as others profit. Either option creates intense psychological discomfort. With the rule, you can acknowledge the opportunity, participate at a measured level, and maintain the clarity to evaluate what happens next. But the most profound benefit is how the test trade rule recalibrates your focus. Without it, your attention fixates on the profit you might miss by staying out. With it, your attention shifts to the process of building exposure properly. The very act of taking a test position satisfies the psychological urge to participate, freeing you from the tunnel vision that FOMO creates. Is it possible that what we call discipline isn't about having more willpower than others, but about creating systems that require less willpower to begin with? Livermore would certainly say yes. His approach wasn't to become superhuman in his self-control. It was to design trading rules that worked with human psychology rather than against it. He understood that even the strongest discipline will fail in moments of extreme market emotion. The test trade rule didn't eliminate the need for discipline, it made discipline sustainable by reducing the psychological burden of each decision. This explains why so many traders can understand market principles perfectly yet still fail to execute them consistently. They approach trading as an intellectual challenge when it's primarily a psychological one. They develop complex strategies for market analysis but neglect the equally important strategy for managing their own behavior. The truth is that markets don't just test your analytical abilities, they test your relationship with uncertainty. your response to disappointment, and your capacity to handle success without abandoning caution. The test trade rule addresses these deeper challenges that conventional trading education often ignores. Consider what happens psychologically when a position moves against you. Without the test trade approach, a significant adverse move creates intense pressure to defend your decision. You look for information that confirms your original thesis and dismiss contradictory evidence. You become entrenched precisely when you should become flexible. Your identity becomes tied to being right rather than being profitable. How different is the experience with a test position? When your initial exposure is deliberately small, a move against you doesn't threaten your self-image or your capital. It provides information rather than inflicting pain. This creates the psychological space to ask, was my timing off? Has the market environment changed? Should I defer further commitment until conditions improve? These questions become navigational tools rather than admissions of failure. Similarly, when a test position moves in your favor, it doesn't trigger the premature celebration or confirmation bias that often leads to overcommitment. Instead, it establishes a foundation for methodical position building. Livermore would add to winning positions not all at once, but in measured increments as the market confirmed his analysis. Each addition was itself a test, a probe into whether momentum was sustainable or faltering. This approach transforms risk management from a defensive tactic to an offensive strategy. Most traders think of risk management as the art of minimizing losses. Livermore understood it as the science of maximizing opportunity by maintaining the psychological clarity to recognize when conditions change. The test trade rule isn't just about protecting capital, it's about preserving the mental state necessary to deploy that capital effectively. Does this methodical approach mean sacrificing potential profit? In the short term, perhaps. A test position that works immediately will generate less profit than a full position would have. But trading isn't about optimizing single transactions, it's about optimizing results across hundreds or thousands of decisions over time. The test trade rule isn't designed to maximize the outcome of any individual trade, it's designed to maximize your longevity and consistency as a market participant. This brings us to perhaps the most counterintuitive aspect of Livermore's approach: the relationship between caution and aggression. Many traders believe these qualities exist in opposition, that caution reduces returns while aggression increases them. Livermore understood that properly applied, caution enables sustainable aggression. By starting with test positions, he could build enormous exposure in confirmed trends without the psychological burden that makes such concentration untenable for most traders. The test trade rule doesn't eliminate risk, it clarifies it. It doesn't prevent losses, it contextualizes them. It doesn't remove emotion from trading, it provides a structure where emotion informs decisions without dictating them. Above all, it transforms FOMO from a liability into an asset, a signal that triggers not impulsive action but systematic engagement. What if the greatest risk to your capital isn't market volatility but the psychological volatility that prevents you from engaging with markets systematically? What if the distinction between amateur and professional isn't the complexity of their analysis but the consistency of their execution? What if the secret to market success isn't finding better opportunities but creating a psychological framework that allows you to exploit the opportunities you already see? These are the questions that Livermore's test trade rule invites us to consider, questions that remain as relevant in today's high-frequency, information-saturated markets as they were a century ago when Livermore developed his methods through painful trial and error. How do we transform Livermore's psychological insights into a practical system for today's markets? The implementation begins not with percentages or position sizes, but with a fundamental reframing. Every new position is a hypothesis to be tested, not a conviction to be defended. Livermore's test trade rule can be structured as a four-phase process: probe, confirm, build, and protect. Each phase has specific parameters and psychological checkpoints designed to maintain control throughout the position lifecycle. The probe phase is where discipline begins. When you identify a potential opportunity, particularly one generating excitement or FOMO, your initial allocation should be limited to 10–15% of your intended full position. This isn't merely about limiting financial risk, it's about creating the psychological conditions for clear thinking. The probe size should be large enough to keep you engaged with the position's movement, but small enough that adverse movement produces information rather than panic. Livermore was mathematical in his approach to this initial sizing. He recognized that a position too small would fail to command attention, While one too large would create the very emotional entanglement the rule was designed to prevent. The 10-15% guideline creates what psychologists would now call an optimal arousal state, enough emotional investment to maintain focus without clouding judgment. The confirm phase is where your hypothesis faces its first real test. After entering your probe position, establish specific confirmation criteria before adding further exposure. These should include not just price targets but pattern completion, volume confirmation, or relative strength measurements. The key insight is that confirmation isn't a single event but a process of accumulating evidence. During this phase, Livermore would look for what he called line synchronization, alignment between multiple timeframes showing the same directional bias. He didn't add to positions simply because they moved in his favor. He added when market structure confirmed the sustainability of that movement. The distinction is crucial. The former creates vulnerability to false breakouts. The latter builds positions in genuine trend development. The build phase implements Livermore's pyramiding methodology. Once confirmation criteria are satisfied, increase your position in pre-planned increments, perhaps 3 additional allocations of 20-30% each. Each increment should require fresh confirmation, not just continued favorable movement. This creates a virtuous cycle, where market evidence drives position sizing rather than emotional acceleration. Livermore's mathematical approach to pyramiding followed a simple but powerful principle. Each additional allocation should require stronger confirmation than the previous one. Your evidence threshold increases proportionally with your exposure. The first addition might require a successful retest of support in an uptrend. The second might require acceleration on increased volume. The third might require relative outperformance against sector peers or broad market indices. This graduated confirmation standard serves as a powerful FOMO antidote. Rather than chasing momentum with increasingly aggressive additions, you're requiring the market to work harder to earn your additional capital. The psychological effect is profound. You become more demanding as your position grows, not more emotionally attached. The protect phase activates once your full position is established. Here, Livermore implemented what he called moving defense lines, dynamic stop levels that evolved with the position's maturity and profit. His stop strategy wasn't based on arbitrary percentages but on structural levels that evolved with the position's maturity and profit. His stop strategy wasn't based on arbitrary percentages but on structural levels that, if violated, would invalidate his thesis. Initial stops were placed at levels that defined the pattern's integrity. As profits developed, stops were moved to lock in percentages of the gain while still allowing room for natural volatility. By starting small and building methodically, his average entry price typically allowed for a risk-reward ratio of at least 1:3 even after building a full position. The test trade approach didn't just manage psychological risk, it created mathematical advantage through superior average entry price compared to all-at-once execution. What makes this 4-phase system so effective against FOMO is how it redirects attention from outcome to process. Each phase has clearly defined actions and evaluations that occupy the mental bandwidth that would otherwise be consumed by emotional responses to market movement. You're no longer asking, should I buy, but rather, has this probe position met the criteria for the next edition? The practical application requires preparation before opportunity presents itself. Define your test position parameters in advance, not just size but the specific confirmation signals that will trigger additional exposure. Create a template with entries for each phase: probe position size, initial stop placement, minimum holding period, confirm technical conditions required, volume thresholds, pattern completion, build increment sizes, escalating confirmation criteria, average price targets, protect stop adjustment rules, profit threshold for defensive positioning, exit criteria. This template becomes your psychological circuit breaker when FOMO threatens to override discipline. The pre-commitment to specific criteria removes the burden of in-the-moment decision-making when emotional pressure is highest. Livermore applied this systematic approach across market conditions, but with important adaptations. In quieter markets, his test positions might be slightly larger and held longer before confirmation. In volatile environments, he reduced initial size and required more emphatic confirmation before building. The system's flexibility came not from abandoning rules during extreme conditions, but from having specific rule variations for different market environments. The true revelation in Livermore's approach is how it transforms market emotions from liabilities into assets. FOMO becomes not a threat to discipline but a signal to implement the test trade. Excitement about a potential opportunity triggers not impulsive action but methodical engagement. Market volatility becomes not a source of anxiety but a provider of entry opportunities for incremental position building. Perhaps most importantly, the test trade rule creates a learning system that improves over time. Each position becomes not just a profit opportunity but a data point in your evolving market understanding. Patterns emerge about which confirmation signals prove most reliable, which market conditions favor which pyramiding approaches, and which defensive adjustments best protect accumulated gains. The system's ultimate value isn't measured solely in profit, but in sustainability, the ability to maintain psychological equilibrium through market cycles that destroy less systematic participants. By transforming FOMO from an overwhelming impulse into a triggering mechanism for disciplined action, Livermore created not just a trading rule, but a framework for market longevity. The market reveals character before it reveals profit. This isn't just poetry, it's practical truth. Every trade exposes not just your analysis of price and pattern, but your relationship with fear, greed, patience, and discipline. The test trade rule isn't merely a risk management technique. It's a mirror that shows you who you are as a market participant. Ask yourself honestly, when was the last time FOMO drove your decision-making? When did you last enter a position not because your system signaled opportunity, but because you couldn't bear watching from the sidelines any longer? These moments of psychological capitulation are rarely profitable, but they're always instructive. They reveal the gap between your trading intentions and your trading reality. Livermore understood that the most dangerous market phenomenon isn't volatility, it's the illusion of easy money. When markets surge and speculation replaces analysis, the pressure to abandon discipline becomes nearly irresistible. The test trade rule creates not just financial protection but psychological insulation against this pressure. It allows you to participate without surrendering control, to engage without abandoning judgment. Consider implementing this approach not as a mechanical rule but as a psychological framework for maintaining clarity when markets are most confusing. Start small, confirm before committing, build systematically, and protect methodically. This isn't just a strategy for individual trades, it's an architecture for sustainable market participation across decades. The ultimate measure of Livermore's wisdom isn't found in any single spectacular gain, but in his ability to survive and thrive through market conditions that destroyed less systematic participants. The test trade rule wasn't about maximizing profit on individual positions, it was about optimizing results across thousands of decisions over time. It wasn't about eliminating risk, but about engaging with risk systematically rather than emotionally. Your greatest trading advantage isn't information, everyone has that. It isn't analysis that can be duplicated. It's psychological consistency, the ability to execute your strategy regardless of market condition or emotional pressure. The test trade rule creates the conditions for this consistency by transforming FOMO from your greatest vulnerability into a signal that triggers your most disciplined response. The next time you feel that urgent impulse to chase a moving market, remember, this feeling isn't a command to act impulsively, it's a signal to implement your system. Your greatest risk isn't missing opportunity, it's abandoning process in pursuit of opportunity. The question isn't whether you'll feel FOMO, you will. The question is whether FOMO will control you or whether you'll control it through systematic engagement. What market situation most consistently triggers your FOMO, and how might Livermore's test trade rule transform your response to that specific trigger?